What's happening all? It is December 26th, day after Christmas. Hope yours was good. Mine was good. It was just relaxing. There's all the kids are out of the house. I got one left in the house. We got to have our grandchild over. Pumpkins, you've seen her on here quite a few times. And it was pretty chill. It was probably one of the most relaxed Christmases I've ever experienced in my entire life. So we just kind of relaxing, hanging around. Didn't do a whole lot of really anything. Just spending time. That was it. Not doing anything. I think that was the whole point. The most in it I did was had a big bison tenderloin, cut that up, and I'm a little bit different when I grill real good steaks. So I'm not, yeah, the grill is great. You got to maintain and watch that damn thing. It's a pain in the ass. I like to take a hardwood like mesquite, throw it into my fire pit. I got a big old fire pit and get that burned, or just throw it out on the dirt. It doesn't matter. Get a bunch of mesquite going until it's just burned down to coals. No more flames. And it's just those red hot coals. Pound those things flat, season up the meat, and just throw it right on top of the coals. That's it. Just let it sit there and sear. You wait probably about maybe 5 minutes on each side, depending upon how you like it. Right? I'm a rare guy. So 3 to 5 minutes on each side, flip it, pull those off. You have to flick a few of the coals off the stick, but it doesn't burn. It doesn't char. I hate charred meat. When I go someplace and they make it Pittsburgh, I can't stand that. So Pittsburgh's the char, if you guys ever heard of that. I don't like that flavor, but it just, for some reason, it just works. So if you never tried that, try it. Hardwood, though, you can't just get out briquettes. That doesn't work. That turns the powder and it sticks to your meat. It's got to be hardwood, oak, mesquite, hickory, something like that. Burn it down to it's just hot red coals and throw your meat right on top of it. It's amazing what it does. And you want to season the hell out of it before you put it in there because the seasoning acts as a barrier too. You're going to leave some of it there. So you want to season a lot. And it just sucks that smoke in. It's awesome. So what we're going to get into now that we got really the last week of the year, today the Federal Housing Finance Administration's Housing Price Index came out, as well as the S&P Case-Shiller Home Price Index. Now, what are these? These are very important indices that shed light on the current state of the housing market. The FHA Housing Price Index and the S&P Case-Shiller Home Index will examine valuable insights and trends in the housing market and how it changes throughout the country. So we'll start with the FHFA House Price Index. Now, again, FHFA is the Federal Housing Finance Agency. They collect data on home prices using mortgage transaction information obtained from Fannie and Freddie. This index is it's unique as it focuses solely on properties that have mortgages purchased and that are done by these two government-sponsored entities. You've heard GSEs, right? That's what Fannie and Freddie are, government-sponsored enterprises. So then to comprehend this particular house price index, it's measure of the house prices on a national level. So it uses a really, really broad sample of properties compared to what others might do. And by tracking the index over time, we can observe the overall appreciation or the depreciation of housing prices across the United States. Now, let's go on to the S&P Case-Shiller Home Price Index. It's named after economists Carl Case and Robert Shiller. This index provides a little bit more of a granular view of the housing market, specifically highlighting trends in 20 major metropolitan areas here in the U.S. Now, this index tracks the price range of single-family homes using repeat sales methodology. It captures information on properties sold multiple times over time, enabling us to understand pricing dynamics on a local level. The inclusion of the 20 major metros allows us to identify regional variations in the housing market, providing us with valuable information for investment decisions and really geographic comparison. Now, why are these two important, and how can we use them to understand the housing market a little better? First, they help us gauge the health of the housing market. Rising prices usually it will signify what's happening as far as a growing market, where the demand is, whether or not it's a supply issue. It's going to lead to appreciating or declining property values. Now, the declining ones will show that we have weakening supply. There's a couple things that could do that, right? It could be just something going on in a particular market that people don't like. There could be an oversupply of the houses. That's what we saw happen in 2008. And the fact something is happening that's going to reduce the demand. So what's one market that saw, and you might see it on my Instagram, it went on a TikTok a long time ago. One market did very, very poorly because of an incident. You go into Minneapolis, Minnesota a few years ago, we had a big situation happening with the death of George Floyd. Because of that, impacted demand. You got to understand certain things that happen in the market can influence that market. right? So it's not a matter of, political or anything to that effect. It has a lot to do with just people and what do people want. So that gives you as a basic understanding of the overall indicators, the economic well-being of the market. The housing market plays a very, very significant role in the broader economy, and understanding the trends that it has can assist in us forecasting the economic performance of the United States, especially the economic performance for you as the real estate investor. So we want to understand these indexes the best we can. So what do we have today? What has happened with them? Well, they both have increased. We have shown that there has been an increase in the price of housing in both indices. So I'm going to go into the S&P Case-Shiller here, and I'm going to show you that chart so you can take a peek at what's happening there. So this particular chart is put out by the St. Louis Fed, and it goes all the way back to January of 1997. So we can see what's happening. 1987. Man, it's amazing when you start getting old and start seeing all these decades that have passed. So 1987, where the hell was I at in 1987? I think I was a sophomore, I believe. Sophomore, yeah, actually, no, it was before that. I was in junior high. Actually, I was a seventh grader in 1987. Then remember that was when the Jordans were coming out around the time. That was becoming the big deal, right? So that was what going on back then. So where are we at? We can see here how the trend has increased over time. We're just seeing this big, massive jump in, or at least increase in housing. It was slow. It wasn't massive. Then you get to right around here in the mid to early 2000s, you start to see this big spike up. This big, well, not really a spike. It's just a really, really steeper incline compared to what we'd seen previously. What was happening here? Well, I got in the industry here in 1997, right here. So where I got into the industry is actually the end of it. We start to see this climb. There's an abnormally quick climb compared to what the previous years were. This was when they started doing your no income, no asset loans, zero down for investor loans, things like that. And then we got into that where it peaked out. You get into to 2008, where everything went to hell. We had the big recession, right? Then everything came out of the recession, climbing right back up. So everything recovered. It really wasn't, we saw that drop down from 2003. The levels of 2009, where it bottomed all out in 2012, was about equal to 2003. So recovered all that, climb right back out of it. Then we get to here, right? It was a pretty steady climb. Now, that steady climb, when you think about the financing, was driving a lot of it. People were having to qualify for financing at this point. This was no longer this get the free loan or a lot of assistance in, well, basically there was no more of those liar's loans, if you will. And there was also no more of the zero down investment properties, really even zero down housing, period. But look what happened. We still had this major increase in people had to qualify. They're being held accountable. Amazing how many people came out of here, 2008, with bankruptcies, with foreclosures, and still we had a market go up. There was a significant amount of bankruptcy and foreclosure, and we still had a market increase. People still bought houses. Now you get to what happens here. What went on right here? This is February, March of 2020, basically. That's COVID. COVID hit, and look what happened. When we get hit with crazy shit, stuff jumps. And look at that. That was because everything got really cheap. Now here, because of all this is all quantitative easing. This was all that cheaper money, lower interest rates. Then we got really low interest rates right in here. And then they shut the faucet off in 2022. That was right around, mid 2022 when they shut that faucet off. It's really, really stopped it towards actually late 2021. But we had that last little bit of people bleeding off from 2021. That's when they shut the market off. Now let's go into the charts, and I can show you all of that so we can see what ended up happening. Let me see here. Here is this share screen. Now we'll match that up. So here we go, right at the end of 2021, and that's where everything fell off. This is where we continue to take that beating. Now here's where we are today. Came back up. We're up at this point. So I'm going to go ahead and change this a little bit. So we start thinking about this. We still saw, as you can see, and let me change screens again. So look at here. So we bottomed out basically February of this year, and we've climbed up. We've had steep increase in rates, and we still climbed up. There's still a lot of buying in the housing market. So February of this year, still climbing up. So I'm going to go and I'm going to share back to our charts. Where are we at February of this year? That would have been right around here. So February, look at this. February this year, steep decline, massive decline, and we still went up. Pricing of housing still went up. A lot of people are still thinking, hey, maybe I can hold out till the market's better because the Fed says it's going to get better. They're going to start dropping the rates. I wouldn't wait for that, guys. Look what happened. Look what happened. They started reporting correctly, a little bit more correctly than what they had been doing when it comes to the jobs market. Really showing what's happening. That's a lot weaker than what they wanted to tell us. All of this increase had to do with them cooking things. Then you get to where, well, the jobs market really is shitty. The market's kind of shitty. The economy's kind of shitty. It's really not as good as we think. Now look what happens. Then we're driving things up. Mortgage-backed securities going in. People are worried about what's going to happen in equities. It's basically why a lot of people would drive money into mortgage-backed securities. So then we get into where we're at today. Look, we went right up to that line that I established way back. This is the level of where the price was when they started quantitative easing in 2008. That is where anything below this was driven by the market. Anything above it was driven by the Fed's quantitative easing. We hit that ceiling and bounced right off it. We are trading sideways, flat as you can get. This right here is what we call the stochastic indicator. When it is above this gray area here, this is overbought, meaning people have way too much money in that market. They should be selling at some point soon. To be cautious, they're going to turn and sell. This is oversold, meaning they sold too much. It's a good buy. They should buy into it. We're in an overbought position. I don't know why it continues to stay there, but it does. And it continues to stay in a position where those who are investing into the economy or into the markets are more secure in the bonds right now than they are in other places. If we see the Fed drop rates, we see things get cheaper, like I was saying last week, we risk seeing this just get really out of hand. The interest rates going way down. We're seeing the market as far as the cost of housing jump and go through the freaking roof. It's already jumping. Don't wish for the Feds to drop the rates, guys, right yet. I think that we should let it sit and simmer a little bit. Another year, hopefully, not moving it a whole hell of a lot, so you can get this to calm down a little bit, because otherwise, house is going to get way out of hand. If you're in a position right now and you've qualified with my team, and they sent you a letter that says you qualify for multiples, let's say 3 of them, and you're working one of those great deals we got going on with one of these providers, and you might be able to buy 2 or 3 of them, I'd seriously consider it. I'd seriously consider being able to pick up a couple, 2 or 3 of these houses now, because I don't know what the price is going to do going forward. Well, we've shown you with the Case-Shiller index that just keep going up, so you're not at risk there. It's just got to buy something you can keep reasonably rented the entire time you own it. You can raise rents on it. It's going to go up in value, and you can keep your costs low as far as the maintenance are concerned. So there's some of you right now working with us with some really significantly awesome interest rates. Some of them are new bills. If you've got a chance to do a couple, 2 or 3 of them, I'd do it. Just my opinion. If you have questions about that, call me. Either cell phone, you can text me, 602-291-3357, 602-291-3357. Text me, say, what are you talking about with these people buying low rate deals or whatever? I'll share it with you. And then we'll go ahead and just wrap it up right here. So text me, share the information with you. If you haven't subscribed, you might want to do that so you get alerted, because we're going to be giving more information out, and then I'll communicate with you on Friday.